Welcome, everybody. Getting a few people more joining us as we speak. So I would like to give you a little bit of an opening and an overview of what we're doing today. So welcome to the Future of Capital Markets in the Digital Age webinar that we're hosting today, and brought to you from Tokyo, Hong Kong, and Australia. So we have speakers in 3 locations for this webinar. And obviously we have an audience across the whole region and even beyond that. For those of you who don't know me, I'm Stefan Nilsson. I am the founder of the Tokyo-based Hedge Funds Club. I'm also a director of the single family office Terrasias Capital. And I have spent most of my career in alternative investments, primarily in the hedge fund space. Many of you will be familiar with the Hedge Funds Club, of course. The Hedge Funds Club is a network of hedge fund managers, investors, and asset managers across the Asia Pacific region. It was founded by me in 2005, and in normal times, obviously we're not exactly in normal times now, but in normal times we host events in Tokyo, Singapore, Hong Kong, and Australia. These will be networking events and educational events. What we're doing now is hosting some webinars for you, promoting our newsletter that comes up twice a month. And we're promoting a lot of content online through our website and social media. Today is obviously one of our webinars that is part of the new normal for the time being. Let's see what happens when we can go back to normal events. Today we've invited our partners at OSL, Asia's leading digital asset platform, to work with us on presenting this webinar. Want to hear their views on this emerging digital asset class. OSL is backed by the BC Technology Group, which is Asia's only listed, licensed, and Big Four audited digital asset and fintech company. OSL is Asia's largest digital asset platform at the moment. They provide prime brokerage, custody, exchange, and software as a service for institutional clients and professional investors, including hedge funds. From OSL today, we have Matt Long, who's the head of distribution and prime, and we also have Ryan Miller, the head of institutional sales at OSL, and they will do an overview of the opportunities and how things are developing in the markets. Both of them have worked in capital markets for about, well, more than 2 decades now, so they're experienced gentlemen. We will also a bit later have crypto fund manager Henrik Andersson, who's the CIO of Apollo Capital, and he's based in Melbourne, Australia. He will share more of his experience as a fund manager, what the issues are, the opportunities, etc. So that will be a fire chat discussion a bit later on today. The topic today is obviously talking about digital assets. And the idea is for everyone to get a good overview of digital assets, the role it can play in people's portfolios, and how this plays into the hedge fund space at the moment specifically. As some of you have seen or heard or know, we've seen a lot of the hedge fund players get involved or getting interested in getting involved. I mean, it's various stages. Some rather famous hedge fund managers have launched crypto funds or other digital asset funds. Some of them are allocating to external crypto managers as part of their macro fund funds or multi-strategy funds. And some of them are trading directly as part of a hedge fund that they already run. So there are different ways, different approaches. And of course, some people are not doing anything yet, but are looking at it because it's becoming more and more institutionalized. So we're going to cover some of that today. We are going to take questions. Of course, we want to be making this interactive, but there are quite a few of you listening in today. So the way we're going to do it is you have a Q&A button that you can see on your Zoom screen. So please type in any questions you have there at any time. And then Matt and Ryan will try to cover these during the speak or at the end of it. So we have time allocated towards the end to answer such questions as well. So don't be shy. Please ask questions. Difficult questions are always allowed. We'll see if we get the answers, but don't be shy. So that's really where we're at. I'm going to hand over to Matt and Ryan, who will start and give you a big overview, and then we will get into the more nitty-gritty, and we'll take it from there. So over to you, Matt and Ryan. Thank you very much.
Terrific, Stefan. Thank you. Thanks very much for the introduction. Ryan and I are really delighted to be joining you today. So thank you for that, and again, thank you everybody for attending. We've got a topic that is we're really passionate about, and which we really look forward to imparting as much as we can about what we are seeing going on in the industry. Look, I think never before have we been more confident that the future of capital markets is going to be a digital one. Now, I guess, what do we think beyond the buzzwords? What does that actually mean? And that we'll actually look to I guess get into some detail on that today. When we think about digitization of capital markets, we think there's already mass adoption of digital infrastructure across banking and markets. You think about internet banking, contactless stored value cards, mobile payments. I mean, there is already a fairly significant infrastructure of digital and digitization across the financial system. I guess, therefore, more specifically, our thesis is a very simple one. So the advent and adoption of new technologies and new products, and so particularly tokenized securities, which leverage the blockchain, is really going to drive the digitization and the transformation of capital markets. And so, furthermore, as that transformation is supported by the advent of virtual banks, central bank digital currencies, the ongoing and continual adoption of different public blockchains, the tokenization of traditional securities. So, all of these things lead to a world where there's increased financial inclusion, continued globalization of platforms and markets, and I guess all of that being underwritten by not only increased availability of the internet, but also ongoing speed and bandwidth that's available across the globe. I think, then looking specifically at that slide, and the slide that's in front of us now, when we look at the pace at which the digital evolution and the digital adoption of capital markets is happening, is really well exemplified in this slide. So if we look back just 3 years, and look across this timeline from the heady highs of Bitcoin in 2017, if we look through till now, the news concerning the pace of adoption of digital assets by governments, by central banks, by regulators, by household financial services names, that pace is just continuing to accelerate. So if we look back through time and look back to the Fidelity's entry into digital markets back in 2018, if we sort of start, play forward a little bit to 2019 and Facebook's announcement of Libra, which really was, I think, a very watershed moment in the adoption of digital assets within capital markets, even though I think a lot of people potentially don't realize the impact that will have as it comes online. Moving forward to the end of 2019, Hong Kong's securities regulator releasing an entire regulatory framework to govern the trading of virtual assets through to 2020, so to this year, when we were actually fortunate enough to receive from the Securities and Futures Commission approval in principle for the running of a Type 1, Type 7 digital asset brokerage and exchange. Through even just in the last couple of months, the Office of the Comptroller of Currencies in the US has mandated that US banks will be able to hold cryptocurrency, hold digital assets on behalf of their customers. And so the point being here, the pace of change and the adoption, from significant players within the financial system has really continued to accelerate over the last couple of years. And again, as we think forward, for us, that really, underwrites the point that the technology that we're talking about here is not actually just technology, but that this is an asset class. So if we could move on to the next slide, please. Thank you. Okay, so given this backdrop of the pace of change and our belief in the digitization of capital markets, today's presentation is going to provide you with our view and a glimpse into the future of those markets and what we see as how these changes are going to have really radical implications for markets. Now, again, though not the core focus of today's discussion, it's important to remember that the blockchain actually underwrites and makes possible the entire discussion that we're having today. And so, although it's become fairly sort of hyped or overhyped in the last couple of years, it is the blockchain that facilitates the advancement of capital markets, and that's very clear. And the reason for that, I think many people on the call today will be aware that the elimination of frictional costs, the reduction of time, the immutability of contract, all of those things that the blockchain delivers, that results in increased efficiency, improved liquidity for both issuers and investors within capital markets. And so, really important to remember that the blockchain underpins our discussion today. The extension from that last point is that as this transformation happens, the opportunities for investors deploying funds and capital raisers going to the market to raise funds, those opportunities just open up dramatically. So opportunities that were not previously available becoming on the product palette and in the availability for asset managers to allocate capital. And so clearly that's really good news for asset managers, for family offices, single and multi-family offices, to pension funds, because again, if you and we see this firsthand in the digital asset investors and traders with whom we deal. They invest for a number of different reasons. By adding digital assets into their portfolios, it changes the shape of their efficient frontier curves. It changes what they are seeing in their Sharpe ratios, the Sortino ratios. It actually adds a different dynamic into the risk return profiles of their portfolios. And we speak with investors and traders who are at varying parts of that journey. So we to think about it. So there are well-known global hedge fund managers running very large portfolios who now allocate into the space. Through to we see many smaller funds who have set up many smaller single family offices who are now allocating into the space for the benefits of that diversification and what happens within portfolios. There is also an aspect of that relates to inflation hedging, and we might come back and talk about that a little bit later. So over the next hour, we're going to cover, and Ryan's going to take the lead and cover a whole lot of ground around what's facilitating this future of capital markets. Step through the regulatory landscape, really, provide some background around the changes and what is happening in the regulatory space, because ultimately that holds the whole fabric together. Without the regulatory framework, the allocation of capital, simply can't scale. Then finally, we'll sort of close out before the panel discussion in having a look at the impacts of COVID and what we've seen over the last 3 to 6 months and what COVID has done to this asset class. So again, look, thank you very much for joining us. We're super excited to share what we know and what we see in markets. And with that, I'll hand on over to Ryan.
Yeah, thanks again. Thank you, Stefan. Thank you, Matt, and to reiterate with the rest of the team, thank you all for joining. I drew the short straw, so I'll start with some of the legal stuff. Please note this presentation is just for information purposes only and does not represent any financial advice. So maybe if I can get started. First and foremost, what are we referring to when we're referring to the term digital assets? So the term digital assets actually originated in the mid-1990s and is referred to items such as videos, images, audio, and documentation. And things didn't really change too much over the next 20 years until the introduction of Bitcoin and the blockchain technology, which, as Matt mentioned, has enabled the creation of a range of financial products and instruments, including stablecoins, security tokens, central bank digital currencies, and most recently, DeFi or decentralized finance. So first, a quick refresher. Bitcoin was founded 11 years ago in 2009 and was the world's first truly decentralized peer-to-peer electronic cash system. Bitcoin was the first blockchain technology the world had ever seen and continues to benefit from the first mover advantage. Like with being number one, it also put a target on its back, which has made it the most thoroughly battle-hardened cryptocurrency to date, and maintains a 60% market cap dominance in comparison to all the other cryptocurrencies combined. As mentioned, Bitcoin was first, but there are now 5,500, give or take, 5,500 cryptocurrencies in circulation with a combined market capitalization of around about $350 billion US dollars. The category also includes some well-known crypto brands such as Ethereum and Ripple. Moving on to ICOs, or initial coin offerings. This also falls in the crypto segment and sometimes referred to as Kickstarter on steroids. Put bluntly, there was no easier and faster way to raise capital during 2017-2018 period than to perform an initial coin offering. And it was the primary driver in pushing the entire crypto market cap to just over 800 billion US dollars. Unfortunately, many of those projects and initiatives succumbed to non-delivery, project exits, and in some cases, fines and jail time for those who ignored the security regulations. Which brings us on to STOs, or security token offerings, also referred to as digital securities, which we can touch on a little bit more in later slides. And this is a tokenized digital form of a traditional security, such as real estate, venture capital, private equity, or gold. We firmly believe that security tokens will play a significant role in the future of capital markets. Stablecoins. As they say in the name, the idea is to eliminate the volatility by backing it against a traditional asset or a widely used fiat currency. At the moment, the most popular coins are focused around US dollars or USD. The most popular one is Tether, or USDT, and has a market cap of 15 billion US dollars. To get a little more granular on what that means, ultimately 15 billion US dollars has been converted into a token and is now in the ecosystem and widely used around the world. The reason for the stable coins was to enable payments and remittances without that volatility that sits around the Bitcoin, which we all know is not afraid to move 5 or 10% in a day. And finally, central bank digital currencies, or CBDCs. This is a digital form of a fiat money. Fiat money as a currency established as a money, fiat currency established as a money by the government regulation or monetary authority or law. So central bank digital currency is highly secure digital instrument. Just like paper notes, it can be used as a means of payment, a unit of account, and a store of value. And like paper notes, each unit is uniquely identifiable to prevent counterfeiting. China is leading the movement for a number of reasons, but pure size of the addressable market and the appetite and success of digital mobile payments seen within the country is undeniable. just moving on to the next slide. One could argue that digital assets are the first new asset class in the last 30 years. Unsurprising, digital assets are still tiny in comparison to the traditional asset class, but we believe it has the potential to disrupt and grow both rapidly in pace and radically in value in the coming years. There's a number of driving factors behind this prediction and the predicted growth, including continued wider acceptance of Bitcoin and the cryptocurrency as a whole. Bitcoin was seen as a fad and has been referred to as fake internet money. But in the last 2 years, and certainly in the last year, it's really cemented itself as a legitimate product with liquidity, and it is simply not going anywhere. We are seeing a shift into, as I mentioned before, a shift into the digital fiat currency and stable coins. And as Matt mentioned, Facebook Libra. This announcement was actually very, very well received by the crypto community or ecosystem, as it effectively introduced the digital asset or cryptocurrency space to its 3 billion active users. The introduction of digital securities that will complement the existing capital markets or capital raising markets in the form of STOs. The other driving factors is continued regulation or further regulation and clarity, and the continued growth within the fintech disruptor space and continued improvement in the banking products, the wealth management, asset management, and insurance products. And finally, the proliferation of the born digital generation, or so my much younger friends tell me. There are many investable digital asset products available for both the retail and the institutional investors today, and is rapidly growing. We only have to look back 2 or 3 years to see how far in both the product offering, the product suite, but also in terms of the liquidity that's seen across the spot market, the futures, the options, and even the coin borrow lending business, allowing a number of market participants to enter the space and to have a number of hedging and yielding products to support their natural position. Of course, Bitcoin still remains the most well-known and utilized and everyone's favorite digital asset. And just looking at the data over the last 10 years, Bitcoin has been largely uncorrelated to equities, fixed income, and even the oil markets. It should also be noted that Bitcoin is the best performing asset in the last decade and is also one of the best investments thus far in 2020. As the world continues to grapple with severe economic fallout from the COVID-19 pandemic, the price of Bitcoin has been on an astonishing bull run, surging more than 100% since its recent lows in March. This resilience and outperformance demonstrates that we're here to stay. It has a life of its own, and most importantly, it has an ability to stand on its own 2 feet without the acceptance of or the assistance of any central bank or government policy. As a result of this uncorrelation and resilience, investors are finding it very difficult to just set aside Bitcoin and cryptocurrencies and not have some exposure to it. This, along with the unlimited quantitative easing from central banks, is also driving many investors to see Bitcoin as an inflation hedge. With all of that in mind, we see a significant opportunity for funds, wealth managers, single multifamily offices, regional banks, and even the top tier banks to obtain the early or first mover advantage by adopting the digital asset investment as a capacity to themselves and of course to their clients. And we've seen that firsthand with the introductions or the interactions we're having with the institutions than we have been having over several years. It's very much moved on from why should I get into the space? What is cryptocurrency? How do I hold it? To now, I would like to get into the space, explain it further. What is the next steps? And we at OSL are playing a role in educating and training them in addition to providing access to the new asset class. If we can take a minute to discuss regulation, which I know is everyone's favorite, but even looking at it, in the majority of jurisdictions around the world are looking to regulate or have regulated digital assets. And whilst Bitcoin has been around for 10 years or 11 years now, it's only recently or relatively recently that we have observed significant interest in the digital assets and central banks, governments, and regulators. And conversely, their views and outlooks have changed dramatically in the last decade. Some examples include that they've largely accepted that the fact that digitalization and decentralized technologies such as cryptocurrencies is here to stay. It's very difficult to stop in some cases, and with that realization, they're quickly formulating a view on regulating the sector. They've also largely accepted the fact that digital assets have the potential to pose a significant benefit not only to their populations by addressing the banking the unbanked, but also more so for the central banks, with primary benefits including improved law enforcement or in taxation enforcement, surveillance and traceability. They've also finally largely accepted that tokenization of securities is going to mature and provide a means to complement the existing capital markets businesses, and furthermore providing benefits such as increased liquidity, fractional ownership, tighter compliance, improved speed and transparency of settlements. I could add also one more point there is we also see the FATF, or the Financial Action Task Force, which is a global body whose objectives are to prevent money laundering and terrorist financing, recently turned a spotlight to the cryptocurrencies. They have a directive known as a travel rule, which will enforce force the crypto sector into compliance with traditional banking regulations. Crypto exchanges, ATSs and wallet providers will have to divulge personal information of the person using their systems and services, exactly the same or very, very similar to the sender and beneficial information attached to a traditional bank transfer. Obviously, this goes against the originating and somewhat libertarian views of Bitcoin. However, what is clear is that regulatory clarity, amongst other factors, is definitely required for institutional adoption. If I may debunk some of the myths, licensing again, which we've touched on, in Hong Kong is geared towards institutional adoption, making it easier for companies and professionals to deal with licensed entities, whether that be asset managers, broker dealers, or operators of automated trading services. You should note, however, that licenses will only cater for servicing of professional investors and does not include retail, which of course at the moment is the largest segment of the crypto space to date. It should also be observed that existing licenses in some regions may already satisfy some participation in space. Again, looking at to Hong Kong, in the Type 9 asset manager license, the SFC will allow up to 10% of your AUM to be invested into virtual assets without any additional accreditation or licensing, which is, of course, been very, very well received this side. We of course hear frequently in the media that Bitcoin is too risky when it comes to AML. Of course, we disagree on that side of things, and digital assets has proven time and time again to be safe and secure, as evidenced by the increased number of quality custodians in the space, as well as robust and thorough AML and KYC requirements taken up by the most professional investors in the space. In fact, technological advancements allow for OSL, for example, to screen every coin and token that enters the platform, assign a risk score in real time to determine whether that digital asset has been tainted by dark web, gambling, exchange theft, ransomware activity, or more. And if it is deemed to have been tainted, we can quarantine the digital assets in a separate wallet. It allows us the flexibility to inform law enforcement, submit an STR, or return the digital assets to the sender address, depending on the circumstances. And if I can get a little granular on that, ultimately what this means is if I received 5 Bitcoin from a certain wallet, I'm able to see which wallet at each and every stage that 5 Bitcoin has touched, and all the wallets it's touched, all the way up to the Genesis block or the time in which it was mined. So I have a large and very transparent view of that 5 Bitcoin and where it came from. Of course, if you want to compare that to the traditional world, if I received $5,000 from Matt, I would only know that it came from Matt. I would have absolutely no idea where Matt received it from. So the AML and the ability to see where the Bitcoin has been all the way up to inception is actually very well received and impressed, and a number of the traditional guys are impressed by this. Talking about traditional guys and moving on to one of the biggest myths is no one in the traditional finance is getting involved. Some of the world's most prominent investment professionals and household financial brands are now involved in this space. And we've seen a huge uptake in this in the last 12 months. For example, the majority of the headlines displayed on this slide were published in the last few months. Asset managers, wealth managers, and other asset allocators will grow market share, acquire additional clients and investors, and produce superior alpha and portfolio returns by adopting the investments into digital assets. It goes without saying that we anticipate some truly game-changing announcements to be made by traditional powerhouse brands before the conclusion of 2020. And we only have to look at Goldman Sachs and JP Morgan, who have both made headlines over the past years denouncing the legitimacy of this space, only to retract that and intend to be first, with JP Morgan now providing banking services to two of the largest regulated crypto exchanges in the US. Institutionalization is happening, and it's worth noting that it's already got a very strong foundation and base, again shown by the quality of the participants and providers on this slide. Historically, there's been three main factors that prevented wider adoption. The factors have been addressed by the market over the last few years, and thus removing the barriers to entry. So number one was regulatory clarity. We saw queues of institutions waiting to participate, but have been waiting on the sideline for the playbook. That playbook has now been provided by innovative regulators, and again, contrary to popular belief, KYC, AML guidelines have existed and are mandatory to impose. Number two is a legitimate, transparent, and trusted, effectively licensed vendors and brokers to facilitate the trading of this asset class. And number three is the quality of custodians. Safeguarding of these funds and actually accepting and holding of digital assets is very new to a large number of the participants. And we've seen a growing number of participants solve this problem within fully insured, audited custodial services. And this provides a level of security and confidence that is afforded to them by traditional custodians. Some of the questions are around the popular inquiries, if you like, in terms of the custody, is how do we securely store and manage the transfer of our digital assets in and out? On the execution side, how do we simply route the client orders to the brokerage desk or interact with the OTC desk? And on the platform, how do we leverage your software as a service platform and your experience in the market so that we can also offer this to our clients? Just shaking it up a little bit and moving on to the STO side of things. A refresher. What are tokens? So a token is a representation of something in a particular ecosystem. It could be a membership, product redemption, utility, voting rights, or anything. A token is not limited to one particular role, and it's tokens that were used during the ICO phase. Secondarily, what is a security? Securities can represent the ownership of a publicly traded corporation, a credit relationship with a governmental body, or the rights or ownership as represented by an option. So what is a security token? In its purest form, a security token is a tokenized digital form of a traditional security. So again, in its purest form, a security token is a tokenized digital form of a traditional security. Now, we're not suggesting that security tokens or offerings will dominate the capital markets in the near future, but they will meaningfully complement the existing capital raising markets that exist today, and they will afford a number of advantages as they mature over time. Such benefits, which including the ones that are not displayed on the screen, include bringing credibility back to the sector. So not a lot of people talk about it, but similar to the technology sector in the dot-com bubble, the digital asset space was rampant with ICOs, offering for the most part a product that was still in process. This unfortunately caused significant losses to the ICO participants. Increased regulation and customer protection is good for this space, and given the ICO bubble that we endured. Significantly faster execution. By removing intermediaries, it will allow the faster execution time and for those successful issuance of security tokens. A much larger addressable market. As a result of fractional ownership and increased access to issuing platforms and secondary markets. By addressable market, I'm referring to both the issuer and the investor. So STOs aim to fill the gap in the market that will allow small to medium-sized firms access the capital markets or access capital raising at a fraction of the cost. That's on the issuer side. On the investor side, it will allow the smaller ticket investors who may not have had access to real early stage investments, the mechanism to do so via STOs. And thirdly, maybe not most importantly, this will increase the liquidity in both the primary and secondary markets. One final sort of advantage here is the potential reduction in institutional manipulation. As a result of the reduced middlemen, it also as a result of transparency achieved through the blockchain and the smart contracts. Following on from this, digital securities eliminate many of the frictions that have long plagued the transfer of private and non-listed alternative assets, offering a greater opportunity, efficiency, and liquidity to investors and issuers. The blockchain technology will save both time and money. And the core strengths of blockchain's technology, which include the shared ledger, the immutability, and security, brings promise of reduced transaction cost and streamlined processes and products to the industry. Some examples of this are security tokens, utility tokens, and payment tokens, which will bring efficiency to the transfer of value. The value can be in form of a payment or access to a platform or the rights of an asset. Tokenized venture funds. The shorter holding periods and increased liquidity will attract more LPs. And with easier exit opportunities from a share-like tokens themselves, VCs are likely to invest more. Asset-backed tokens will allow access to industries such as the $54 trillion commercial real estate industry. Local governments are also exploring the benefits of security tokens in the form of a crypto bond, which will also access the $3.8 trillion municipal bond market. In keeping with throwing large numbers out to impress you, an article was recently published last week actually, and reported that the World Economic Forum estimates that up to 10% of the global GDP will be stored and transacted via distributed ledger technology by 2027. Similar to my previous slides, or our previous slides, and demonstrating traditional finance participation, the same is starting to apply for the security token segment. As you can see here in the list of issuing institutions as reported by PwC's STO report last year. There's some well-known brands there raising significant money, and we see this continuing. We're nearing the end of my presentation before we head to the fireside chats and some Q&A. And whilst not directly related to the digital assets or capital markets, it wouldn't be a 2020 Zoom without commenting on COVID-19. We see COVID-19 accelerating the erosion of trust in fiat currencies and hastening the interest in institutional adoption of digital currencies. In one of my previous slides, and certainly one of the most popular headlines, was the purchase of $425 million, or give or take, of Bitcoin, a position taken by Michael Saylor, the CEO of the business intelligence and mobile services firm MicroStrategy. He was out there on Twitter, and sort of actually walked a number of people through, anybody I guess who was following him, how he did this position, or how he took on this large position. It's reported that this was a lion's share of the firm's treasury reserves, which he had shifted from short-term US government securities. And if I can quote him, he said, "We really felt we were on a $500 million melting ice block," or ice cube. I want to give the exact quote. And again, in recent months, the COVID is playing a role in central banks having stepped up their digital currency trails. Bitcoin digital asset regulation is a race to the moon for governments. And what has become abundantly clear as we head full steam towards a cashless society is that digital payments is the gateway to the future and even broader adoption. To finalize, and maybe some conclusions, digital assets have evolved into highly liquid financial products and represents a new asset class in the last 30 years. With this new asset class brings a whole new opportunity for any of the investors to find any kind of anomalies in the systems. ARB is starting to really play a significant role, and the opportunity, and with liquidity, as I've mentioned a few times before, with that liquidity, you're now able to make some real money and really diverse or allocate a certain amount of your assets into the space. The digital asset landscape is highly sophisticated, and asset classes has been seen as uncorrelated. Global regulation, which we mentioned a few times, created the right conditions for institutional investors to enter the space and helped eliminate the barriers to entry. So again, those barriers were very much around the regulation clarity, the providers, the vendors out there that had all the bells and whistles that are required, and of course the custody on the end. The sector is experiencing, and the ecosystem has created a healthy competition and innovation. STOs and tokenized securities is the future of the capital markets, and certainly on raising for small to medium enterprises. And finally, COVID-19 has accelerated digital asset adoption and brought us drivers to the forefront. So thank you once again for listening. I think I want to pass it over to Stefan and Henrik for the fireside chat. Hi, Henrik.
Hi, Ryan. How are you?
Yes, I'm very good. Thank you. Very good. Thank you. I guess if I could start and maybe ask for yourself to just do an introduction on yourself, your history, and then your current fund and what you have seen over the sort of 3 to 4 years that you've been in this space, if you've not been in for longer.
Well, I actually got into the crypto space around 7 years ago. Before that, I spent some 15 years in traditional finance. My background is in quant equities. I worked across Scandinavia, Singapore, and New York. I spent 10 years in New York. Most of the time in the equity business, in quant equities, both on the buy side and sell side. And got into crypto 7 years ago. Moved to Australia a few years ago and started one of the first crypto funds down here. So I run a crypto fund in Australia called Apollo Capital. I've been running that for the past 3 years. So it's been an interesting journey. We launched in the beginning of 2018, which was a bear market in the crypto space. But our investors have been hanging in with us, and now they're enjoying very good returns because we have enjoyed the DeFi market, and I think we've been well positioned, not just with exposure to Bitcoin and Ethereum, the largest assets, but we have seen a lot of growth outside those assets recently as well. So it's been quite a journey, and it's been interesting to see the investors interested in the digital assets market as well, because I think that has changed together with the infrastructure as well in the digital asset market the past 3 years.
Fantastic. So yeah, maybe I'll just quickly jump in. I think Matt might have a question after me, but yeah, I just wanted to touch on that. I mean, I think that from our point of view, we definitely see. I've been in the industry for 2.5 years, which as everybody knows in the crypto sphere, that means 20. You know, you know, I've seen a significant difference, you know, really, and I did touch on it, you know, the product offering, the institutions, everything has changed and has really sort of adapted significantly. And it takes some time to just look at it and at a sort of an outsider's point of view and just take a step back and look and say, wow, it actually has changed a significant amount. So just maybe my question over to you is, what do you think has been the biggest change you've seen, maybe from your investors, the people knocking on your door, over the last 2 years?
Yeah, so we have seen the change in the infrastructure, but we've also seen the change in the type of investors who are coming into the market. So on that latter point, we have seen, I guess the crypto market for a long time was driven by retail investors mainly. When we started the fund, we were mainly marketing towards high net worth individuals. And that really have changed the last couple of years to more family offices and also institutional investors who are getting ready for this market. So I think that has changed, and I think the change from the 2017 ICO market, as you touched upon before, has been remarkable when it comes to the infrastructure as well that is supporting this industry. Things like custody, which was not at an institutional level 2-3 years ago, but really there are institutional custody solutions like the things that you're offering at OSL and Coinbase Custody and other major players in the industry. Even traditional financial institutions are getting into the custody business of digital assets. So that's definitely one part. When it comes to exchanges, we have regulated exchanges now in the market that we didn't have 2-3 years ago. So that has changed a lot as well. And also the type of instruments that you can trade with the rise of CME futures backed and so on. I think that has really transformed the industry the last couple of years.
Can I ask, so Henrik, do you invest in traditional assets as well, or are your mandates constrained to digital assets?
We currently focus solely on digital assets.
Got it.
So all crypto assets are our universe of investable assets, primary market and secondary market.
Understood. And when you, I guess in the last couple of months, how interested have your investors been in, I guess the underlying positions that you're taking, and as it's evolved, as the DeFi market sort of has evolved, has that been? I'm just again wondering how interesting those conversations have been with your investors.
Yeah, we have seen the DeFi market really explode the past 6 months, which has led to fantastic returns for all unit holders, and also increased interest in kind of capturing the yield that we see in the DeFi market. We believe that the yields will come down over time because they are at elevated levels at the moment. But I think a lot of our investors that are even investors, I think, that are quite deep in the crypto markets, I realize it's very hard for them to be on top of everything that is happening in the DeFi market because it's changing so quickly. So I think they really see a need of professional management in that area. And I think it was the biggest lending protocol Compound that really kicked off this trend back in June of this year, and since then we have seen huge growth in that area.
I think that just for the rest of the attendees and stuff, ultimately the DeFi space is decentralized finance. It covers right now the most important part, or the most popular, is the borrowing and lending and generating yield, as Henrik mentioned. The difference, I think, it definitely had a huge spike in the interest, and some of the coins are doing 2,000-3,000% over a month. Some of these governance tokens, and I think a lot of people were wary of that. It could be an ICO 2017, 2018 repeat. The market has come off since then, but I think that one of the key differences is that all of these products have a working product. You're able to log in right now and stake your coins or yield farm and effectively generate a yield today. It's just, as you mentioned, the yielding and will it drop off? So maybe my question is, how do you see as ensuring as an ecosystem that this doesn't sort of turn into another bubble?
Yeah, no, that's a good question, and certainly it felt a bit bubbly in some of these governance tokens, as you mentioned as well, and some of them have already come off their heights quite substantially, right? For us, providing liquidity to some of these platforms, we don't necessarily take that volatility risk. We can generate a quite nice, healthy return or yield, as you say, by providing liquidity and sometimes using stable coins, and we don't necessarily risk the volatility in the governance tokens. But I think it would make sense for them for the yields to come down, and surely some of these governance tokens will fall in value over time, right? So it's probably not where you want to be exposed in the market necessarily right now. I think right now we might see perhaps a trend back to Bitcoin. I mean, Bitcoin has done fairly well year to date. I think it's up something like 46% year to date, better than almost all major traditional assets out there. But as we see these governance tokens fall in value and yields coming down in the DeFi market, we might see capital moving back to something like Bitcoin, which seems to be holding the 10,000 mark quite well here, and I think that's an important level for Bitcoin. So that's the way we're thinking about it.
Yeah. So just touching on the yield, just for everybody on the call, what kind of a yield are you seeing right now in a, as you know, obviously it's a little bit riskier, but in your risk, with your risk capacity, what yields are you seeing?
Yeah, using stable coins, 6 months ago we were able to generate annualized yield of hundreds of percent on some of these platforms, right? That has definitely come down to 30-40% at the moment, and I expect them to go down further. Again, using stable coins, you don't necessarily have to take that volatility risk. You can provide liquidity to these kind of platforms, lending platforms or so-called decentralized exchanges, and by doing that, you can get rewarded by these governance tokens that you're free to realize the value of.
Sure.
But you probably shouldn't keep holding these governance tokens for the long term unless they're one of the really high quality projects out there, and there are a few of those, right? They are really high quality and it's been around for some time, and there you could see value longer term, we believe. But that's probably not the case of the majority of the governance tokens out there.
Okay. I was going to sort of change gears with a little bit and ask a different sort of question. How do you find fundraising? So again, a lot of the managers that we talk to and that we deal with, fundraising is a really interesting exercise. And in out and talking to new families or new funds that are allocating into the space for the first time, how have you seen that evolve perhaps over the last 12 months or 24 months? Is there an increasing sophistication and an increasing understanding about the underlying asset class? How have you seen that evolve as a manager when you're out raising funds?
No, that's a good question. So we're definitely seeing an increased appetite for alternative assets, if you like. So away perhaps from the stock market that I think many see as perhaps topish, and perhaps they see valuation at quite high level in the stock market. Bond market might not be that attractive to them. So when we speak to family offices, they do have an interest in the alternative asset class. Real estate has been very popular down here in Australia for many family offices, the real estate market. And that outlook is perhaps not that bright either at the moment. So there is an increased interest for assets like gold, perhaps also as a macro hedge. And I think that has increased the last, I would say, 6 to 9 months after COVID that you talked about earlier as well, where we see central banks printing money all over the world, and now we have unlimited QE. And I think that has really increased the appetite for scarce assets like gold, and I think Bitcoin is more and more seen as a form of digital gold as well. So we definitely see I think with the macro backdrop we have at the moment is quite favorable for Bitcoin and digital assets at large. And then, of course, like always the case with fundraising, the interest will increase with returns, right? So it seems to lag kind of. If you produce good returns, right, then the interest will automatically be there in some sense.
If I could, maybe if I can just also ask another question there, Henrik. In terms of strategy, I know a lot. There's a significant amount of hedge funds that have started up, and it's effectively long only. It's just a way in which for an investor to step into a space with a nice vehicle. Maybe if you could just talk a little bit about your strategies and how many you have, and where if you believe those are the most popular ones.
Yeah. So the Apollo Capital Fund is a multi-strategy fund. Setting up the fund originally, kind of we thought about what was be the best strategy for this new asset class, right? As you mentioned, it's the first new asset class in perhaps 30 years. And by being a new asset class is fairly immature, right? So we think it's probably too early to focus solely on one strategy because it's not developed enough. So if you can be a multi-strategy, you can really find the best alpha opportunities across a number of strategies, and that's really, I think, have played out quite nicely for us the past 3 years. So our fund we have one bucket that is fundamental long only, but we also do things like market neutral, arbitrage, event-driven trades, and lately yield farming. So you have to be quite adaptable to the market. It's changing very quickly, and if you can have kind of a broad multi-strategy outlook, you can find opportunities in the different strategies over time, which I think will be helpful, and I think that's still the way to go.
So, on behalf of all the panelists, OSL, and I'd like to thank all the attendees for joining. As mentioned, we can reach out on the side if you have any additional questions. And thanks again, one and all.
Thank you, everybody. Thank you to OSL, Matt, Ryan, Henrik.